obligations when borrowing money or issuing debt. So this usually translates into lower interest rates, longer repayment periods, or simply being able to access financing that might otherwise be unavailable due to perceived risk. And essentially, it is about making your debt look less risky so you can pay less for it. For example, nice small business wants a loan, but banks see it as risky. So by offering a personal guarantee from the owner like a form of credit enhancement, a bank's risk is lowered and it might offer the loan at a more reasonable interest rates. So next is the application. Widely used in various financial contexts, including first is corporate debt. So corporate debt for companies issuing bonds or taking out loans. So companies use credit enhancement to improve the terms on bonds they issue or loans they take out, especially if their own credit rating is not strong enough to attract investors at low cost. For example, a medium-sized company or bigger rated wants to issue 50 million in bonds. So para makuha ang lower interest rate, it secures a letter of credit from a large AA-rated bank, which promises to pay bondholders if the company defaults, and this effectively gives the bank's higher rating. So next is the project finance. So project finance for large-scale infrastructure or development projects. So large complex projects like building a power plant or bridge often involve significant risk over long periods. So credit enhancements helps reduce this risk for lenders, making massive long-term financing and long-term financing possible. And last is the securitization. Securitization, a crucial component in structured finance products like asset-backed securities or ABS, mortgage-backed securities or MBS, and collateralized debt obligations or CDOS. So in securitization, a pool of assets like mortgage or auto loans is bundled and sold as securities to investors. So credit ratings is vital here to protect investors from defaults within the pool, allowing different layers of securities or tranches achieve varying credit ratings. Next is the benefits of credit enhancements. So credit enhancements offer significant advantages for both borrowers and the investors. For borrowers or issuers, so first here is a lower borrowing cost. Lower borrowing costs by reducing the risk, enhanced debt often qualifies for lower interest rates, leading to substantial cost savings over the life of the loan or bond. So for example, a company initially facing 8% interest rates on a loan due to is the increased marketability. So a higher rating or the risk security is generally more appealing to investors, increasing its liquidity and ease of sale in their secondary market. So for example, asset-backed securities or ABS structured with subordination or senior or junior tranches are easily sold to diverse investors because highly rated senior tranches are very appealing and liquid, while the junior tranches attract risk-tolerant buyers. And last, enhanced reputation. So demonstrating a commitment to risk mitigation can improve a company's financial reputation and stakeholder trust. So for example, a utility company consistently uses reserve accounts and structured financing to ensure debt service payments on its infrastructure projects. So this proactive risk management builds a reputation for financial prudence, increasing investor confidence and making future fundraising easier.
So next is for lenders investors. So first is reduce risk exposure. So credit enhancement provides a cushion against potential losses from defaults on the underlying assets, making the investment safer. So credit enhancement creates a buffer or protective layer, significantly reducing the chance that the investors will lose money if the original borrower defaults or the underlying assets perform poorly. So the second is increased confidence. So investors have greater assurance receiving timely principal and interest payments even in adverse academic scenarios. So investors gain greater assurance that they will receive their scheduled principal and interest payments on time. So even if the economy worsens of the original issuer, they are facing difficulties. Next is the portfolio diversification. So it allows investors to participate in projects or asset classes they might otherwise deem too risky, thus diversifying their portfolios. So credit enhancement allows investors to safely include investments in riskier projects or asset classes which they might normally avoid, and also in their portfolios, thus spreading out the risk and potentially enhancing overall returns. And next is the improved risk-adjusted returns. So by lowering the risk without necessarily reducing the yield significantly, credit enhancement can lead to more attractive risk-adjusted returns. So by effectively lowering the risk of an investment or boosting its credit rating without drastically cutting its potential yield. So credit enhancement can lead to more attractive return relative to the amount of risk taken. So next is the internal credit enhancement techniques. So these strategies are built into the structure of the financial transaction itself, utilizing the underlying assets or cash flows. So first is the subordination or credit branching senior subordinated structure. So the debt is divided into different classes or tranches with varying levels of seniority regarding claims on cash flows and assets. How it works? So senior tranches have priority in receiving payments and are protected by the junior or subordinated tranches. So in case of losses, the junior tranches absorb the first losses, providing a cushion for the senior tranches. So next is the external credit enhancement techniques. So this involves third parties providing additional security or guarantees for the debt. So first is surety bonds or bond insurance. So an insurance company, often a monoline insurer, so issues a policy guaranteeing the timely payment of principal and interest on a bond issue. So how it works? So if the issuer defaults, the bond insurer steps in to make the payments to bondholders. So the bond's rating often reflects the credit rating into the insurer. So next is letter of credit or LOCS. So next is excess spread. So the difference between the interest rate earned on the underlying collateral and the interest rate paid on the issued securities. So how it works? So this excess interest can be used to cover losses, build up reserve accounts, or prepaid principal, providing a first line of defense against defaults. So for example, if the underlying mortgage yields 7% at the issued ABS pays 4%, the 3% excess spread can absorb losses. Fourth is reserve accounts or cash reserve accounts. So a dedicated account established and funded with cash or highly liquid assets at the outset of the transactions. So how it works? So these funds are set aside to cover shortfalls in principal or interest payments. If the underlying collateral performs poorly, they can be fixed or accumulated over time. So next is over-collateralization or OC. The face value of the underlying collateral pool is intentionally larger than the par value of securities issued against it. So how it works? So this creates a buffer. If some of the underlying loans default, there is still enough collateral value to cover the payments of the issued securities. So next is excess spread. So the difference between the interest rate earned on the underlying collateral and the interest rate paid on the issued securities. Next is the letter of credit. So financial institutions or typical bank issues an irrevocable promise to reimburse the issuer for any cash shortfalls from the collateral up to a specified amount. So the bank effectively provides a credit guarantee allowing the debt to be rated based on the bank's creditworthiness. Next is the bank guarantees. So a direct promise from a bank to cover deficits in the debt service payments if the primary borrower fails to meet its obligations. So similar to LOCs, but can be structured more broadly to cover various payments obligations. So fourth is third-party guarantees. So a financially strong third party or a parent company, government agency, or multilateral development bank pledges to cover a portion or all of the debt in the case of default. So the guarantor's credit strength enhances the credit quality of the debt. So next is the wrapped securities. So security whose principal and or interest payments are guaranteed by a third-party issuer or guarantor. So this effectively overlays the credit of the third party and to the underlying security, improving its credit rating.
Next is due diligence. So what is due diligence? Due diligence is the careful investigation of a person or business before finalizing an agreement. It involves verifying facts and assessing risk to ensure information decision-making. This process is essential in areas like business deals and legal matters. So due diligence is the process of carefully checking and investigating information before making a big decision, especially in a business or legal situations. So the goal is to make sure everything is accurate and that there are no hiding problems or risks. For example, if mo invest ka in a certain company, dapat kay na due diligence. Imagine na carefully check the company if whether that is a profitable or if there are any risks. So next is types of due diligence. First is hard due diligence, focuses on quantifiable data such as financial statements and legal documents. So it is the process of checking the exact facts and numbers about the business before making a decision, like buying or investing in it. So there are types of due diligence. First is hard due diligence, focuses on quantifiable data such as financial statements and legal documents. So it is the process of checking the exact facts and numbers about business before making a decision, like buying or investing in it. So it focuses on information that can be measured, proven, or verified using documents. For example, when someone wants to buy a company that will look at it, the company's financial records like profits, losses, and debts and income. So next is soft diligence. Looks at the qualitative factors including management quality and employee morale and customer relationships. So soft due diligence is the process
diligence means carefully examining a company's financial records to understand how financially healthy it is. This process helps investors or buyers decide if the company is a good and safe investment. So this includes things like income statements to see how much money the company makes and spends. In a short, financial due diligence is the process of analyzing a company's financial data to make sure it is stable, profitable, and not hiding any financial problems. Next is legal due diligence. So, legal due diligence is the process of carefully reviewing a company's legal documents and contracts to find any possible legal problems or risks before making a decision, such as buying the company or investing in it. So, this includes checking contracts and agreements with customers, suppliers, or partners to ensure they are valid and fair. Next is operational due diligence. Operational due diligence is the process of evaluating how well the company runs its day-to-day activities and business processes. So it looks at how efficient, effective, and reliable the company's operations are before making a decision like investing or buying. So next is tax due diligence. It is the process of carefully examining a company's tax situation to identify any outstanding tax liabilities, risks, or compliance issues before making a deal or investment. So next is environmental due diligence. Environmental due diligence is the process of assessing a company's impact on the environment and making sure it follows environmental laws and regulations before a deal or investment. So this includes checking compliance with environmental laws to confirm the company meets all local, national, and international environmental regulations. So next is commercial due diligence. Commercial due diligence is a process of analyzing a company's place to the market, so its competition and its potential for future growth before making an investment or purchase. So next is the human resources due diligence. So it is the process of evaluating a company's workforce, employee policies, and labor practices before a deal or investment. So this includes reviewing employee relations, how will the company manage relationships between employees and management, including any ongoing disputes or union activities, so like compensation and benefits, so whether salaries, bonuses, and benefits are fair, competitive, and properly documented. So next is intellectual property due diligence. So intellectual property due diligence, it is the process of reviewing verifying company's ownership, rights, and a proper use of intellectual property assets before a deal, investment, or partnership. So next is common elements document provides some credit information. Analyzing every issuer can be costly and time-consuming. To simplify decision-making, investors rely on these two methods, the name recognition and the formal credit rating. First is name recognition. Name recognition means investors trust a company or government simply because it has well-known and respected name. So, name recognition is when investor trusts a company or government based on its strong reputation and financial history. They assume well-known entities are reliable and unlikely to default on their debts. However, relying only on reputation can be risky. Like in 1995 when Bearing Banks collapsed despite its prestigious name. Because of its such risk, investors often combine name recognition with credit rating, which provides a formal assessment of an issuer's financial stability. So next is formal credit rating. Formal credit rating is an official score given by a credit rating agency like Moody's, S&P, or Fitch that shows how likely it is that a borrower such as company or government will pay back a specific debt like a bond on time and full. So a formal credit rating is an official assessment provided by a specialized agency to evaluate the risk of the company, government, or financial instrument failing to meet its debt obligation. This rating helps investors understand how likely an issuer is to repay its debt on time. Organizations like Standard & Poor's, Moody's, and Fitch conduct credit evaluation. For example, if a company receives a AAA rating, it means a strong financial position and is highly unlikely to default. On the other hand, a BB rating suggests higher risk, meaning investors might demand higher return for the lending money to the company. So these are the summary of a credit rating agency bond rating. So as you can see in the investment grade, high credit quality, these are the bonds that are more likely to pay back money on time. Then speculative lower credit quality. So then speculative grade lower credit quality, these are the riskier bonds, sometimes called junk bonds. And lastly, the high speculative default risk. These are rating indicate very high risk or that the issuer may already be default or not paying back.
My topic is all about financial guarantors. So, what is financial guarantors? A financial guarantor is an individual or entity that agrees to pay a borrower's debt if the borrower fails to do so. So, this fundamental concept of a financial guarantor, simply put, if someone, the borrower, takes on debt like loan and they can pay it back, the financial guarantor is the person or entity that agreed to step in the pay that debt. So what is guarantors? A guarantor is someone who guarantees a loan or debt obligation for a company by offering their own asset as collateral. So the role of guarantor, particularly in the context of company's financial obligation, it highlights the guarantor often puts their own asset at risk collateral. This means if company they are guaranteeing the debt or fails to pay, the lender could potentially claim the guarantor's personal asset to recover the funds. This underscores the significant personal financial risks involved being a guarantor, especially for a company. Why are financial guarantors important? Financial guarantees are significant because they enable transactions that might not happen otherwise, allowing higher-risk borrowers to access credit. So, financial guarantees can make it possible for individuals or companies considered high risk to obtain the credit that they might not otherwise qualify for. The guarantor's promise to pay mitigates and the lender's concern about borrowers' ability to repay. Next is, it can lower the cost of borrowing for the borrower, especially if the guarantor has strong credit rating. A guarantee from a highly rated entity can lead to better financing terms. So, lower borrowing cost if the guarantor has a strong financial financial standing and the credit rating, their guarantee can make the borrower appears less risky to the lender. This reduced perceived risk can lead to the borrower receive more favorable terms such as lower interest rates. So next is provide reassurance to lenders, encouraging to them to extend credit. So provide this reassurance to lenders knowing that the guarantor is backing to them gives lenders more confidence and extending credit. This can lead to a greater availability of loans and financings in the market. So types of financial guarantees. So number one is contract bonds. So contract bonds, these guarantee that the terms and conditions of the contract will be fulfilled. So second is payment guarantees. So payment guarantees, these assure that a specific payment will be made. And the third is performance bonds. So performance bonds, these guarantee that a particular task or project will be completed as agreed. So number four is bank guarantees. So bank guarantees, these are undertakings of the bank to pay a certain sum of if bank's client fails to fulfill a contractual obligation. Another one is surety funds. So surety funds is involve three parties. Number one is the principal, the obliged, and the surety. And guarantees that the principal will fulfill an obligation. So number six is standby letters of credit. So standby letters of credit, these are similar to bank guarantees and partial payment if certain conditions are met. Number seven is unconditional guarantees. So unconditional guarantees, this requires the guarantor to pay upon demand regardless of the result for the borrower's default. And lastly, number eight, conditional guarantees. So conditional guarantees, this requires certain conditions to be met before the guarantor is obliged to pay. And there are other types of guarantees include this expands on types of guarantees, highlighting their diverse application in various commercial and financial contexts. So number one is the advance payment guarantee. So it guarantees the return of an advance payment if the supplier fails to fulfill their obligation. So number two is the bid bond or tender guarantee. So bid bond or tender guarantee assures that a bidder will enter into a contract if their bid is accepted. So number three is the customs guarantee. So customs guarantee ensures that custom duties and taxes will be paid. So number four is deferred payment guarantee. So deferred payment guarantee guarantees payment at a future date. So next is the rental guarantee. So rental guarantee assures that the rental payments will be made. Next is retention money guarantee. So retention money guarantee allows a contractor to receive retained funds before the end of a project with a guarantee ensuring completion. Next is the warranty guarantee. So we all know about the warranty. It covers defects, goods, or services for a specified period. Next is the credit enhancement guarantees. So credit enhancement guarantees improve the credit worthiness of a debt issue. Next is loan guarantees. Specifically, guarantee the payment of a loan is loan for guarantees. Then next is shipping guarantees. So it facilitates the release of goods before the original bill of lading arrives.